everybody, to Replace Your Dollar Bootcamp 3.0, day number 2, September 26th, 2023. Giving everybody a few moments to get populated into the meeting. Let me make sure that I have the chat set up for everybody, but welcome back to day number 2. Very excited that everyone is here. And let's just go ahead and test this chat. Test. Can everybody see that? Can I get a thumbs up? Test. All right, got a test back. Yes. All right, fantastic. All right, like we did yesterday, we're going to wait until 8:02. Give everybody a few moments to pop in here, and then we will get started. But welcome, everyone. This is day number 2 of the Replace Your Dollar Bootcamp 3.0. The second of 4 days in this event, and very excited that you're all here with me here tonight. So while we are waiting for everyone else to get in, I'm going to set up the presentation, and then we are going to get rolling. All right. How about to get started? If we can throw me something positive or good that happened to you today, something good from your day. Something positive from your day. The Cubs didn't lose. $0 lost on trades. Got more contracts. Woke up. There you go. It's the small wins. Talk to me. Chiropractor appointment. Starting listening to my podcast. Oh, well, thank you. You had a great dinner. Ate well. Started a paper trading account. All right. Made money in the market. All right. A lot of good stuff here. I'm a big believer in always starting with something that is going well, taking a moment to recognize those good things in our life, because a lot of times we focus on the negatives. Kyle says here, having a showing on his house for sale, created a multi-company vision statement, back traded Roku after losing. All right, lots of good stuff. To my word, it is 8:02. We're going to go ahead and get started. And just want to thank everybody for being here for day number 2 of the boot camp. Had a lot of fun yesterday with all of you. Excited that you're back here for day number 2. And just a quick note about the recordings. I am recording each of these videos, and they are only going to be shared with those who registered to start. I actually have the first video. It's finishing its upload right now to YouTube. So that is going to be sent to your email probably when we get off of this meeting. If not tonight, then definitely tomorrow AM. So be sure to check for that. And I will try to have night 2 up for you as well. So you'll be able to access these recordings for forever. They're going to be yours to check. So just wanted to give you a note about that. And with that said, let's take a look at our outcomes for tonight, what we're going to be going over. We're going to quickly review day 1, and we're going to practice our trivia skills, because that's how you're going to win the funded accounts on Thursday. So we'll get some practice in. We're going to get into candlestick charts, line charts. We're going to talk about the differences between day trading, swing trading, investing. And what does it mean to go long on a stock or to go short on a stock? We're going to get into all of that. So we're really going to dive deep and get into some technicals here tonight. I'm very excited to do that. So make sure you have your notebooks ready. I talked about being a student of the market, and that should have started for you yesterday. If you're serious about this, taking notes, and this is really going to set you up going through this event of giving you a strong foundation to move forward in your understanding of trading. As I said, I'm going to be posting my link for this discovery call in the chat for all of you multiple times as we go through the presentation. And if you are interested in learning more about trading, if you are interested in learning more about coaching, mentoring, the programs that we offer, if you'd like to work with me as you begin this journey, please click on that link, set up a call. Several of you have already done that, but I'm looking forward to talking to a lot of you, a lot more of you, talk to a few of you today about trading and how I can help. So before we get started and jump into the new content, let's get into some practice for the quizzing on Thursday, because the way you're going to win the funded account I'm going to ask 2 questions and anything can be covered from these 4 days. And whoever responds first and with the correct answer wins that account. So let's just get your fingers warmed up here, and let's just go ahead and throw a G in the chat. All right, you got a G in there. Get your fingers warmed up a little bit. Now with your left pointer finger, let's get a Z. Can we get a Z? All right, we got a Z in there. All right, so your hands are warmed up. All right, so here we go. Practice question number 1. Remember, this is just good practice for what we're going to do on Thursday. All right. What do we call the trend in the stock market when it's moving down? Bearish. Yes, all of those are good. All right, so we got everybody nailed that one. All right, and let's see if you're paying attention to this. This is not necessarily trading talk. Who's my favorite football team? All right, Steelers. I'm waiting for the smart aleck comment. It's the Steeler. There we go. There it is. Steelers. All right, so there's some practice there. And again, like I said yesterday, please make sure you participate, pause, ask questions. I will stop every so often to go through the questions and make sure I'm clarifying or answering anything that you're uncertain about, unsure about, or you have questions about. And because we're going to be diving into some of the technicals of the charts, please make sure you do engage, because that's going to help you learn this. All right. So we're going to jump right in here. So we're going to start by talking about what is a stock. All right. It may seem very basic, but you will often terms hear stocks referred to as shares, equities. And essentially, if you own stock, if you have shares of a company, you own a percentage of that company, you are a business owner. So I refer to my son, who has a few shares of Coca-Cola, as a business owner. And I say, hey, buddy, how does it feel that you own a piece of a business? Or sometimes when I'm talking to family or friends, I'm like, yeah, he's a business owner at 8 years old. But that's essentially what it means. When you own stock, now, albeit it's a very small percentage, you're a business owner. Now, why is this important? Because when we own shares of a company, when we own stock, we can make money while we're sleeping passively. We don't have to do anything. If you just buy and hold a stock for a long enough period of time, and it's a good company with good fundamentals, good leadership, they're profitable, it's going to increase in value. It's going to go up, and you're going to make money while you sleep. And if you look at the wealthiest people in our country, they own shares, they own stocks, right? So we all should own some companies. We all need to own shares, okay? So one way of owning shares, albeit for a brief period of time, and what I'm going to go into now is the difference between day trading, swing trading, and long-term investing. But one way that you can own shares briefly and be a business owner for a couple hours, and then you could be a business seller, right? All within a day. You are a day trader. That's day trading. And when we define day trading, all that it means is that you're in and out of a trade within a day. And when we say trade, all we are talking about, what we mean by that is buying and selling stocks. That's what it means to trade, okay? The market hours, the regular market hours, are open 9:30 a.m. to 4 p.m. Eastern time. Now, that's going to be different if you're on the West Coast, if you're Central time, obviously. But that's the primary time when the market is traded. That's when the most transactions occur. That's where the most volume is. There is something known, and not to complicate or make this more complex than it needs to be, there is something known as post-market trading, which occurs from 4 p.m. to 8 p.m. And there's not a lot of volume, not a lot of shares are being moved at that time, but people still trade it, maybe people in other countries or large institutions. And there's also what's known as pre-market trading. And that's from 4 a.m. Eastern time to 9:29 a.m. Eastern time. And it's the same thing, very low volume. You have people in other countries who are trading who weren't able to do so because of time differences. And mainly this is your institutional traders. But what we focus on as day traders or as swing traders is the regular market open 9:30 a.m. to 4 p.m. Okay. When we day trade, we are doing two things. That's it. right? So let's simplify this as much as possible. And like we talked about the trend yesterday, we are either taking bullish trades where we are trading the market as it goes up. Remember, that's what the markets were designed to do. And what we are doing is we are buying stocks at a low price, and then we are selling them high. It's a very simple concept. Or we are taking bearish trades. If you've seen what's been happening in the market the last week and a half, it's been a downtrend, right? We can profit off those, and we trade the market as it goes down. We do what is called shorting the stock, where we sell it high, we buy it back low, we pocket that difference in shares. So regardless of what the market's doing, as day traders, we are able to profit from bullish and bearish trades. Okay. So how do we know how to trade? How do we know where to get in, where to get out? How do we manage our risk? It all starts by reading candlestick charts. And if you can read a candlestick chart, you can trade anything, whether it's stocks, futures, cryptocurrencies, Forex. It all begins with candlestick charts. And that's what we're going to get into tonight, how to read and interpret these crazy looking things called candles that we could see right here. We're going to talk more about that. And in a few slides, you're going to know all the different parts of candles. Now, you think of candlesticks, you think of like, you're lighting a flame, and they kind of look like that. I could see where that comes from. But the cool thing about these candles is they can make you money. So when we look at candlestick charts, we are looking at two different types of candles. And if I go back to this slide, you'll see that my candles, this is a picture of my chart here. You'll see that I have white candles and I have black candles. Typically, if you subscribe to a charting application, the one that I would recommend is TradingView. You can go to tradingview.com and set up a free account. The candles are going to come as red and green, okay? Red being representing the price going down, green representing the price going up. And you might be asking, well, why are your candles black and white? Well, it's very simple. I try to take as much emotion out of this process as possible. And I've turned my bullish candles, the green candles, into white candles. And I've turned my bearish candles, those red candles, into black candles. Okay, so that's what the colors represent. Like I said, whenever you look at a normal chart, the green candles are going to represent bull candles, the price going up. Red candles, bear candles, price going down. I've changed the color of mine from green to white and from red to black to take the emotion out. And this came at the recommendation of my coach to just get rid of as much emotion as possible. So when we look at these candlesticks give us 4 pieces of information. And you can see what that information here is on the chart. And we're going to go through this. So remember, when we talk about the black candles, we are talking about bearish candles. And what that means is the price is going down. Okay? When we talk about our white candles or our green candles, that means the price is going up. It's increasing. Now, regardless if it's a bearish or bullish candle, here's our bear, right? I'm going to write with my mouse. Hey, that's pretty neat. Here's our bull, all right? These are the 4 pieces of information that we get. We're going to start with this upper wick on this candle, and that's what they call it. This thing that sticks out here, it's like the candle wick, right? You're lighting it with the lighter. This upper wick, or shadow, some people call it, the tip of this represents the highest price of the day. All right, so that upper wick represents the highest price of the day. If we come down here to the bottom of this candle, we see this tail, they'll sometimes call it, or shadow, or wick, the lower wick. Just as this represented the highest price of the day up here, this lower wick represents the lowest price of the day, or whatever time frame that we're looking at. We're pretending that these are daily candles right now, okay? So the upper wick, highest price of the day, lower wick, lowest price of the day. So those are 2 pieces of information we get from a candle. Now, you'll notice this rectangular body shape here on the candle, right? This can be all types of size. It could be really long and big. It could be very tiny. It could be skinny. This one's decently sized, but we have two pieces of information that's given in the candle body. And for a bear candles indicate that the price is moving down, okay? So because the price is moving down, the upper part of this body indicates where the stock opened, where the stock price opened. So the top of that body represents the opening price, okay? Now, because it's a bearish candle and that price goes down, the open on a bear candle is always going to be higher than your close. And so the bottom part of that candle body of a bear candle is the closing price. So you could see on a bear candle, the price opens higher than where it closes. Okay? So a candlestick that represents the candle closing lower than where it opened, that is a bearish candle. So those are our four parts of a bear candle: the high of the day, the low of the day, the open, and the close. Okay? Now, if we flip that and we go to a bull candle, here's our bull candle right here. It's going to be, a lot of these parts carry over the same except for the candle body, right? This upper wick, this shadow, whatever you want to call it. And those might be part of the trivia question, so make sure you're taking notes. This represents the highest price of the day. It's just like you'll find on a bear candle. And this lower wick, this tail, this shadow, whatever you want to call it, like a bear candle, it represents the lowest price of the day. All right, so it's the same. The upper wick, highest price of the day, lower wick, lowest price of the day. Now, because this is a bull candle, that means that the price is going up. All right, so because it's going up, the bottom of that candle is going to be the price where the stock opens. So it's just the reverse from that bearish candle. The bottom of that candle is the price where it opens. And because throughout the day it goes up and it goes up and it goes up and it closes here, it closes higher than where it opened. That is the closing price of the day. So that, in a nutshell, are your candlesticks. That is your bear candle. That is your bull candle. What questions do you have that I can clarify before we move to the next slide? So Travis says of the day or the designated time frame. Yeah, so here's a unique thing about candles. They can be any type of time frames: daily, weekly, monthly, 1 minute, 2 minute, 3 minute, 5 minute, whatever time frame you want. We're referring to them here on this slide as daily candles. So it looks like we're all good here. You can make money in a bear market. We're going to go over that. I'll explain that here in a second, but it looks like everybody feels pretty good about the candles, but that's the candles, right? So now let's go to the next slide and take a look at typically how stocks are represented to us in popular media, whether you're flipping through a magazine or you see something on the TV screen that says, oh, you know, Tesla is up however many points today, or the S&P 500 is down so many points. Typically, we see that represented with this type of chart right here, and this is known as a line chart, right? This is probably how you have experienced or encountered stocks in your life. And when you go from seeing this, which looks pretty basic and simple, to a candlestick chart, it's like, wow, brain overload. But the challenge here is whenever we look at a line chart, we're only getting one piece of information here. Depending on what the time frame is for a line chart, the piece of information you're getting is where the stock closed in terms of its price on any given day. And that's how it's plotted. And so when you plot those prices, the line just follows those prices in terms of the close. All right. So that's typically how stocks are presented to us in the popular media is through these line charts. But I want to ask a question. Which chart would we want to use for trading, day trading or swing trading or investing? Would it be a candlestick chart or a line chart, and why? All right, I'm seeing a lot of you say candlestick charts. Why would we want a candlestick chart? More information, see more detail, more details. Yep. And somebody put in there that you want to use both. You can, because one of the nice things about a line chart is it's going to help you see what the overall trend is, right? It's going to eliminate a lot of that extra information. But in order to see those specifics of prices of open and close, highs and lows, we're only going to get that through the candlestick chart, right? And again, if you can read a candlestick chart, you can trade. And that's what we're going to focus on drilling into today. Now, when we talk about a trade, again, trading is just buying and selling stocks. There are three components of a trade, right? It's your ESP, we'll call it, if we want to try to remember this. That might be a trivia question too. The three components of a trade, we're always going to talk about our entry, right? That's where we're getting into the trade. That's where we're buying or where we're selling. Buying to go long on a stock, to go bullish, or selling to go short on a stock, right? That's our entry spot. Our stop loss is how we protect our risk, and that's a certain price that we pre-identify in advance, and I'll show you how to calculate this on night number 4. But we're setting a certain price area that if our trade goes against us, we get stopped out of the trade for a loss that we decide in advance. So one of the myths I talked about last night, a lot of people think that when you trade, you're risking everything. If you trade without a stop loss, you could be, but when you have that stop loss in your broker, if the trade goes against you, whatever it is that you're willing to lose, that's what you'll lose on a trade when you have a stop loss. So that's how we protect our risk. And then the other component of a trade is identifying that profit target that we're looking to achieve, right? And that's based on something that we're going to identify on the charts known as support and resistance. And we're setting that price point that, hey, when this stock hits this price, exit us from the trade for our profit. So when you enter a trade, you're automating all three of these things in your brokerage system to where you could set it up, walk away, come back at the end of the day with the confidence of knowing that you'll only get entered into the trade where you wanted to get entered. You'll only be exited if it hits your stop loss, meaning you can only lose what you decide to lose in advance. And if you happen to win, it's based on that profit taker that you set in advance. So how cool is that? You could study your charts and set up a trade in the morning, put in your broker, not check it, come back at the end of the day, and you know that, hey, if my risk is $100, I can come back and check this trade, and yeah, I may not have won, but I will only lose $100, right? You can automate this stuff, okay? So let's go ahead and take a look at some examples of a few trades here, okay? This is a trade on Netflix, and this is a bullish trade, okay? So I'm going to walk you through how this trade was set up and how it works. All right, so we have our candlestick chart here. This is Netflix, and you can see that our entry, right, one of the components of the trade is right here at this line, this 358.67, right above this bear candle right here. And this is a particular strategy that we use to trade. It's called the 10 EMA strategy. So our entry is placed right here, okay? Our stop loss, which you can see right down here, this is another part of the trade where we're protecting our risk. And we're placing it down below a support, which is this candle right here. And that's what this line represents. And that stop loss is 357.76. So basically what that means is if this trade were to go against us and it pulled back and it hit this price, we would be exited from the trade with a loss that we predetermined. And the loss here is $910, right? Because we are purchasing 1,000 shares for this trade. This is just a hypothetical example, right? So no matter if this thing just kept dropping and dropping and dropping and dropping, we would only lose this number, this $910, because that's what we establish in advance. That's one of the things that most people don't realize about trading is you can predetermine all of this in advance to protect your capital. Now, the third part of the trade is our profit taker, which we are setting at 360.52 right up here. This is near what we would call resistance. We'll talk about that more later on. And we could see that if we hit that target with 1,000 shares, because it has gone up $1.85 from where we entered, our profit would be $1,850. And you could see with this trade, we get triggered in, it goes up, it hits target, and that's $1,850. This is a bullish trade, and this is using candlestick chart to set the trade up. Okay? Questions about this? And let me delete so I can read this here. Let's see. Is there ever a reason to not use a stop loss as if you're sitting there watching the trade nonstop? They call that a mental stop, and I absolutely would discourage that whatsoever, because in the heat of the moment of a trade, if it goes against you, there could be the desire to say, I'm just going to let this run, and then thousands of dollars later, you're wishing that you had that stop loss in there. Now, if it's a long-term investment that you're holding on to for an extended period of time, typically you don't have a stop loss in for that. But for a day trade, we always want to protect our risk. What happens if you enter at $10, your stop loss is 8 and your profit taker is 13, but the stock moves very little and never hits 8 or 13. So then if it moves a little in your direction, you take a small win, right? And a win is a win. So you would have to exit, manually check in on that if that was a day trade. What was the reason that you picked a target? 360.52 is a target. So we're going to get into this, I believe, tomorrow when we talk about resistance. Resistance is where we set our profit takers when we're going bullish. So that's why, and resistance is just a particular area where we know the stock will pull back when it's moving bullish. So we try to pick a space where we know the stock has a good opportunity to move, and we try to capitalize on that. All right, Travis was giving an example with crypto. All right, how did you know where the resistance to take the profit was? So again, we're going to get into that resistance. So I will teach you guys that. Bob says paper trading will reveal the necessity of a day trade stop loss. Yep. We're going to get into risk. I'll show you how to calculate your risk on night 4. So that is coming. Yes. How often do you manually? So it depends. I mean, now, again, it's not always going to hit your target, right? So you might have, and this was David's question, you might have a trade that does something like this where, you get triggered in, but then it just kind of chops, right? It does something like that. So then what you would have to do is you'd have to manually exit that trade, which is very, very easy to do. You can do it on your phone. Or let's say that it goes up and then it comes back down, doesn't stop you out. You just need to exit for a small loss. So that's all you would do in those types of situations, okay? So that is a bullish trade. All right, now we are going to look at what is known as a short. All right, and this concept takes a little bit of chewing on to get comfortable with and get familiar with, because it does seem a little awkward at first. And looking at this chart, this is a very, very tight stop loss. This was a trade that I took very, very early on in trading, and this was very trading with tight stops, you have very little room for error, but let me explain to you how a short works. Okay. So for a short, and this is one of the biggest myths about the market, is people think that, hey, when the market's going down, like when I tell people that I trade, they're like, oh, the market's terrible. You're probably losing money right and left. No, you can still make money when it goes down. And it's called a short. You're shorting a stock. Here's how it works. What we do is we borrow shares from our broker, right? The broker being the organization that we use to buy and sell stocks. We borrow shares and then we sell them at a higher price. All right. So that area where we sell, that is known as our entry on a short, right? So here's our entry. We are entering this at 358.09, right below this bull candle right here. All right. This is the 10 EMA trading strategy. Okay. We're not getting into the strategy here now. I'm just going through the basics. But when we hit this price point, we get triggered into the trade. The broker loans us the shares. We sell them. Now, here's what freaks people out. Well, how am I going to sell something that I don't own? What you're doing is you're borrowing it from your broker, and you're going to pay a tiny, tiny bit of interest. Now, think about this. This is a day trade. You're in and out within maybe an hour or two, maybe 3 at most. You know, like some outliers, you might have been there for more than that. You're paying pennies on the dollar for that interest to borrow those shares. And I can tell you, I short hundreds of thousands of dollars of shares, have shorted $1 million worth of shares before. My interest that I pay monthly, maybe $100, $150. So it's very, very small what you're going to pay, because that's the first thing everybody freaks out. Oh, I got to pay interest. No, because it's a day trade and you're not going to be moving big numbers like that right away. But it's not something that should scare you away from shorting stocks, right? Because that it robs you of an entire opportunity to trade the market when it goes down. So here's our entry. Our stop loss is just the flip of a bullish trade. So this is a bearish trade. We're making money as it goes down. Our stop loss is going to go up top, because in a short, if the stock starts going up, that's where you're losing money. Okay. So you have to protect your risk if it goes up and goes against you. So our stop loss is set at 358.57. Okay. Our profit target is set down here near what is known as a support, and we're being conservative with it. And so if this trade works out, which it does, it's $125 per share. It goes down, hits target, and because we had 1,000 shares, we pocket $1,250 because we sold those shares at 358.09. We bought them back at 356.84 and then sold those to the broker. We keep the difference. All right. That might seem like a little bit of a difficult concept, and it took me a while to get comfortable with the concept of shorting. So if you feel a little confused with it, that is completely normal and natural. Okay. But when you are learning to trade, you need to know how to short, because it allows you to make money when the market is going down, right? And there are going to be times when the market is going down, like the past week and a half, and those are opportunities for you to make money. Okay. So that is a short. What questions do you have about a short that I can answer for you? Let's see. We have a few questions here. What is a realistic number to start with in order for it to be worthwhile? That's from Dan. Dan, if you're asking account size, any number is good to start with, because even if you start small and you're learning this and you're taking it slow and you grow that account, 10 years from now, you're not going to say, man, I wish I wouldn't have started trading with just $1,000. Because if you grow that account and you learn this and you get really good at it, you're going to be thankful that you did, and you could trade with larger numbers. So again, like I said yesterday, this is not a get rich quick scheme. This is like anything that you have to work at. If you're going to put the time into it and build, and you're going to be patient, then it could definitely pay off and be very valuable for your financial life. Trend is your friend. Absolutely, Kyle. You know, when the market's going down, you trade with the trend. These are 3-minute candles. Yes, Jared, thanks for pointing that out. Jack says I have to let this sink in. Yep, it definitely takes time to understand it. So again, if you're not getting it right away, that's okay, because a lot of people, when they first start out trading, they stick with bullish trades. That's what I did. When I started, it was just all bullish trades. I would short a share here and there, and I'd be like, I don't get it. Like, what am I not getting? And it just took practice and repetition. So don't beat yourself up over that. Will there always be shares available to borrow from the broker for a short trade? So I've never encountered the broker not having shortable shares. So yes, sometimes if you're trading penny stocks, penny stock is anything under $5, which I absolutely do not recommend at all. That is very, very risky. But if you're trading blue chip stocks, good companies, and you're shorting those companies, there's always going to be available shares to short. Correct. Paul says 25K in order, unlimited day trades, but that doesn't mean you need to risk the full 25K. And if you wanted to swing trade, which is anything over a day, which we'll talk about here in a minute, you can trade with less than 25,000. The other part, there is other people's money out there to trade with. Those accounts that we're giving away, it eliminates the need for you to use your own capital. You pass an assessment, you get funded, you can start out by trading other people's money. So that is not an obstacle for your trading. How much do you need to swing trade? You could start with as little as a couple $100. Jeremy, if you cash account, you're not subject to pattern day trading issues. I have a Robinhood account, and I called them about that last night. So I used Robinhood when I started. There was the pattern day trading rule was in effect for my account. So maybe you have some type of unique account there. If you're using margin, which we're eventually going to talk about, basically what margin is you get 4 times whatever you have in your account. And what I'll do is I'll bring up the specifics in terms of that pattern day trading rule, but I don't want you guys to get hung up on that. But I'll look at that in reference to some of the big brokerage firms out there so you can see how that applies. But I don't want you to think of that as being something that would limit your trading, because there are ways to work around it. Significance of 3-minute candles versus a longer time frame. So you're going to use 3-minute candles for day trading. Your longer time frame candles, like your daily, your monthly, weekly, you'll use for your swing trades and long-term investments. How do you know when a market is going to form a bear to short? Or basically, how do you know when the trend is bearish? So that's something that we'll get into. And basically, it's where key levels of price action, and we talked briefly about support and resistance, which we're eventually going to get into. Whenever those key levels get broken to the upside, we know that we're in a bullish trend. When they get broken to the downside, that indicates we're in a bearish trend. So that's what we want to pay attention to indicate what the trend is if we're bullish or bearish. Blue chip companies would be like your Microsoft, your Apple, Tesla, companies that are profitable, have been around for a long time. They're not going bankrupt. So that's what you want to focus on, at least to start. The problem with penny stocks, and this is why I discourage people from, at least early on, trading with them, is because they are low volume and a low price. Their price action can be manipulated very easily. And what will often happen is you'll see penny stocks, their price gets driven up, and then people are like, oh, I'm going to get in on this trade. And then you have these big timers with deep pockets come in and short it. They drive this price down, and then everybody that got in here loses their money. So they can be easily manipulated. And that's just a piece of advice, everyone. Steer clear of penny stocks, at least to start. All right. All right, I'm going to move forward. I know there's still some more questions in there. I'll try to get to them all. Your questions are phenomenal, by the way. Thank you. That's what I want. I want to have that engagement, but I do want to keep moving here a little bit. But those are your bullish and bearish trades. That's day trading, 3-minute chart. Quick movements we're taking advantage of. And here's the other thing too. Check this out. And I have done this before. You could do this as well. So you could have shorted here, made money on this move to the downside, and then you could have got in bullish here with a stop loss here and taken that bullish, right? So a lot of times opportunities, bullish and bearish, exist in one day on one stock on one chart. All right. So when we talk about there being unlimited opportunities in the market, they are there if you know what you're doing. All right. So day trading in and out within the day. When we talk about swing trading, and a lot of you who work full time or think, man, I can't day trade, then you can swing trade. And basically what it means to swing trade, it's any type of trade that lasts longer than a day, up to a few months or even beyond, right? Swing trading, you can really come up with a detailed plan. You can wait for a price to pull back at a spot where you want to get in. You can set up your stop loss. You can set up your profit taker, and you have nothing but time to watch it play out. So for those of you who are working but want to trade, you can absolutely swing trade and apply all these principles and be profitable and make money. And quite honestly, swing trading is not as intense as day trading. And if you learn how to day trade, when you go to swing trade or long-term invest, it's like, oh, this is pretty simple, right? And it's the same thing. A bullish swing trade is trading the market when it goes up, and you can do bearish swing trades where you trade the market over a long period of time as the market goes down. So same concepts. And again, that pattern day trading rule does not apply to swing trading because you're not in and out within the day. You're waiting a period of days to hit your target. And I always say this at this point in the boot camp. Day trading may not be for everybody, but everybody should at least swing trade and long-term invest in their portfolio. I'm a firm believer in that because it's not difficult to do, right? That doesn't mean just go out and do it without knowing what you're doing, but learn it, study it, practice it, and then experiment with it and see, wow, I really can do this, right? So that's all we're talking about with the swing trade, all right? Let me see if I have an example here. Close this out. So, and again, swing trading would just be, let's say that these were daily candles, right? So say we shorted here on this stock. Let's say that this was a daily chart. This would be a day. This would be a day. You have that full day to manage the trade, right? So you have time. Here's the cool thing that I didn't even get into, right? And this is something else that you're probably not thinking of. As the trade begins to run in your favor, you can move your stop loss into the money so that you now have an unlosable trade, that's called actively managing your trades. It's something that I do all the time. If I have a stock in a trade that moves in my direction, I will move my stop loss immediately. So I'm protected. So if it pulls back, yeah, I get stopped out of the trade, but I'm stopped out for a profit. So that's the other thing to keep in mind. There are active things that you can do to protect yourself. And as the trade begins to work for you, you move that stop loss, you protect yourself, and you ensure that you can't lose. The other part is applicable too. So let's say that this thing is really strong and it's running. You could adjust your profit target to move it so that you can capture more profit. All those things are possible through trading. Okay. And that we call that trailing your stops. All right. So again, swing trading, anything that lasts longer than a day. And then we talk about long-term investing, right? And that's buying and holding stocks long-term and capitalizing on their value. Typically, a lot of people say 5 years, but it could be a year, it could be 2 years. And something crazy that when I learned this, I was like, what? How is this possible? How many of you out there right now own 100 shares of a stock? Just type a 1 in the chat if you have 100 shares of a stock. All right, a lot of you do. All right, so I will tell you this right now. If you own 100 shares of a stock, you are missing out on passive income every month using a strategy known as covered calls. Basically, what it is it's stock insurance that you can sell monthly where someone will pay you to rent out your shares, a premium, based on the number of shares that you have. So let's say that you have 300 shares. You sell a covered call. The premium is $2 per share. You can generate $600 a month in passive income because of those shares. Let's say that 600 is on average times 12. I can't do that in my head really fast because I told you I was an English teacher. That's $7,200 extra dollars per year by pressing a few buttons. I mean, it's amazing, right? Now, here's the one thing I want to show you. Typically, when you talk about investing in stocks, people talk about buying and holding. And I'm going to tell you why that is not a great idea, right? But this is typically what people do. This is what I used to do whenever I invested, right? So let me stop my share, and I'm actually going to pull a chart, and we're going to look at Apple. And give me 1 second here. Apple. All right, share this puppy here. All right. So here is Apple on the chart. These are daily candles. Let me hide all of these other indicators so it's not clouding up the screen. But typically, here's how we're taught to invest, right? And this is how I used to do it, right? If I had a little bit of extra money, I'd be like, all right, well, hey, I got some extra money. I'm going to buy my kid some Apple at 176.16. All right. And then Apple goes down. I come into a little bit of money. I'm going to buy some shares of Apple here, 155.85. All right. And then Apple comes down. I got a little bit of more money. I'm like, all right, I'm going to buy some Apple at 187.93. And then you just buy and hold it, right? But if you look at this chart, you could see that there are other areas where the stock is really cheap. That if we would have just bought at those areas, if we could have identified those in advance, we would have known where to purchase a good blue chip stock like Apple, right? So if you're buying at these random spots and you're holding it, you're not maximizing your return. But if just through some basic application of technical analysis, and that's just analyzing charts, and you can identify where support areas are, and we're going to talk about this in I think tomorrow. Support areas are where the stock typically bounce, right? Like right here or right here. And see this range? It comes down in this range and it bounces, comes down into a range, bounces, comes down into this area and bounces. These support areas can be found on all stocks, on all different time frames. But in the past few years on Apple, really, was this 2022, even into the beginning of 2023, if you would have known that this is a support area for Apple, instead of buying in random places, you build up your cash. When it gets into that support area, you buy it, right? And instead of holding forever, you identify what is known as resistance, which is the area when it typically hits in a range that it pulls back. And we see that it pulls back when it gets in this range, the price. So if we know that, we could be conservative and say, all right, when we get close to that resistance, this is a selling point. So you could buy at these supports, sell, hold on to your money, wait for it to pull back to support, buy, set a target at a resistance, sell. Your returns by doing this versus just buying and holding and buying at random prices, compare the numbers. And you can do that on your own, and you will see the difference and the impact that this can have in terms of your investing. Now, this isn't buying and holding for years and years and years. This is the smart way to invest. Buying at those low key areas on good stocks where they have bounced before, and selling where they pull back, right? So that's just a quick tip on how to use what is known as support and resistance to control your own investments, where to buy and where to sell. And you can find these support and resistance areas on all stocks. They are there. Okay. So coming back over here to the slides, let me bring this back up. So that's what we're talking about when we talk about long-term investing. And I'm going to get to some questions here in a second. So when we compare the three, right, day trading, the similarities between all three, they can make you a lot of money. And you could do day trading, swing trading, bullish or bearish. Investing, because it's such a long period of time, you typically don't want to be in short for over a year, because then your interest can add up, especially if you have a big position. The differences between the three of these: day trading, obviously in and out within the day, does require active management. You're capitalizing on smaller movements. Swing trading, a day or longer, does require weekly or intermittent management, even daily. I would encourage looking at it daily if you're in a swing trade and you're capitalizing on bigger movements in the market. And then investing, you're using those longer time frames, daily, weekly, monthly, using your support and resistance, and that requires periodic management. So depending on what your personality or style is, how much time that you have available to you, you could probably see and identify, all right, I'm really into day trading. This fits with my personality, or all three, or, with my job right now, this is the best place for me to start. Or, hey, I'm just looking to build long-term wealth where it doesn't require me to have to constantly be studying charts. Then investing, controlling your investments, that could be the better way forward for you. So that's the difference between those three. Okay. So questions in the chat about what we covered, or do all three? Yes, I think day trading, like I said, you have to have the right personality for it, but everybody should be swing trading and investing. That's just my personal opinion. What questions do you have about the differences between the three? Kyle wants to sit on the charts and scalp all day. Scalp meaning in and out really quickly on trades. Kyle, I hear you. Paul asks, can you collect dividends when yes, you can collect dividends in the covered call. So think about that. You own shares long. You're making money as the stock goes up in value. You have your covered call premium and you collect a dividend. Beautiful. And then if you're following that support resistance method of active investing, I mean, your returns can be awesome. Other questions? What was the time frame on? So the time frames on the covered call, you could do those monthly. So they are what are known as options contracts. You could do them weekly. You can do them monthly. You can do them 3 months out, 6 months out, 1 year out, 2 years out. And there's all different time frames. The further out in time you go and you sell those covered calls, you can bring in a significant chunk of cash. But the problem is if it goes up beyond what you're selling those calls at, you can miss out on a pretty big profit, excuse me. Yes, you can reinvest dividends. Does ROI teach covered calls? Yes. Does crypto trading have covered calls? So I'll be honest, I don't trade crypto yet. I've spent my time in the stock realm. I don't believe that they do. But I'm not certain. That's something I can get an answer for you on, though. Here's the other thing. If just to take this a step further, so I talked about covered calls. So The other thing that you could do is you could get paid to buy shares of a stock that you want to own long term. So I talked about how, if you have 100 shares of a stock, you could sell covered calls. Let's say that you want to buy 100 shares of a company. You could do what they call selling puts, right? Where someone will pay you a premium, let's say $2, because you want to buy 100 shares of Apple, but it has to hit a certain price. So let's say you're selling these puts for $160 and there's an expiration date with it. If it hits that $160, not only are you keeping this $200 premium, but you're also getting to buy your Apple shares at the price you wanted. Now, here's the cool thing. If it doesn't expire at this price, you keep this $200 for free. So instead of just buying your stocks that you want to hold outright long term, instead of just buying them, you should sell puts, take the premium, so you're getting paid to buy shares you want to own long term. All right, so that might be a little bit more advanced, but I'm just throwing that out here to show everybody what's possible through the market. So Brick says, can I say that one more time? So when you sell puts, let's say there's a stock that you want to own, you want to buy shares, you can sell puts to say, I want to own Apple at $160 by such and such an expiration date. If at that expiration date, the Apple's at 160, you keep the premium of $200 and you get to buy your shares of Apple at 160. If it's not 160, let's say it's $161 or $165, you keep that $200 in premium from selling the puts, but then you can also wait. You could sell more puts, collect another $200, wait for it to get to 160, and then buy your shares. Yes, there has to be enough money in your account to purchase those shares. Correct. Yep. Albert says, can you realistically make enough swing trading to replace a day job? Yes. Yep. Now, again, you've got to work to get to that point. You're not just going to start trading and do that right away. But over time, if you learn it and you practice it, you develop it, you absolutely can. Some of my biggest trades have been swing trades. But it's possible. It's possible. Discovery calls Eastern time. They could be any time. And I'll just pause for a moment. Let me throw that link in the chat here. If you are interested in setting up a call, I got to copy it here. Let me throw that in here. If you want to learn more, that is in the chat. Discovery call, just go over, just learn about your interests, your goals with trading, and talk about how potentially I can help you through coaching, clarify any questions that you have. So that's essentially what we do in those discovery calls. Okay. So let's do this. Let's kind of do a quick review and we'll come back and I'll see if you guys have any more questions. But so far tonight, this is what we covered. We talked about what it means when the market is bullish, when it's bearish. We talked about what a stock is, how it essentially means you're a business owner. We talked about those three components of a trade. We talked about what it means to go long on a stock when we're going bullish and we're taking it upwards, how to short a stock. We talked about the differences between day trading, investing, swing trading. I talked about how to use support and resistance for long-term investing. We talked about the differences between candlestick charts, line charts. So now let's get some practice in. Let's make this information stick. Let's do a quick chat practice quiz and go ahead and throw a 1 in the chat if you're ready to go get some practice. Awesome. So here is the first question. All right. Question number 1. When we short a stock, we are borrowing shares from our broker to sell. Fantastic. Awesome. True or false? we pay a ton of interest when we borrow shares as short on a day trade. False. Very good. We pay very little interest. Now, if you're holding a long term swing trade when you're going short, you could pay some interest, but not on a day trade. What are the three components of a trade? ESP. There we go. All right, that was quick. Entry, stop loss, profit taker. The next one, the upper shadow or wick on a bull or bear candle represents the what? Right? Highest price of whatever that candle is, right? How about the bottom part of a bearish candle body represents the what? The close. Remember, the bottom part of a bearish candle body, remember, it opens higher, it closes lower. Okay. The upper part of the bullish candle body represents what? The close, right? Because it closes higher than it opens. And then the final question to wrap up here, in what type of trade are we in for longer than a day? All right, awesome. Awesome. You guys did a great job. We're getting practice. As we continue through the days, we're going to get into more technicals, more chart reading. But these are the basics. If you feel like you have a handle on being able to look at a candlestick chart, you know those parts, you know the trend, you know the different types of trading, you know those three parts, you have a strong enough foundation to where we now could start layering things in. And tomorrow we are going to, and here are the outcomes for tomorrow. We're going to start getting into support and resistance. We're going to talk about confirming the trend of the stock. And then I'm going to show you a strategy that's known as the hammer candle strategy and how you can use that for a trade entry. So we'll get into all that. We'll do a practice quiz again. And then what we're going to do on Thursday before we do the quiz for the funded accounts, I'm going to walk you through how to calculate your risk and how to actually set up some trades. So we still have a ton more content to cover. But I want to thank everybody for being here, for everything that you've done up to this point. Hopefully you're taking good notes. And if you missed the start of this, so the video from the first night will be sent out to your email. If not tonight, tomorrow morning. So that'll be coming. You guys, all the participants will get the videos first, and then I'll share them with everybody else. But any questions before we wrap up here tonight? Trading platform that I recommend, Interactive Brokers, IBKR. So you can check that out, and I'll talk more about that as we move through here. Yep, I'll definitely be doing some more walkthroughs on average, how long the past eval accounts. You have an unlimited time to do that. You just have to take one trade every 30 days. So there's no time frame. All right. All right. Well, everybody, thank you. Can't wait to see you back here tomorrow. I can't believe that's an hour. That went by pretty quickly. I could talk about this stuff all day, but be on the lookout for the video coming your way. If you have questions, you can email me, jeremyritz@replaceyouruniversity.com. Set up a discovery call if you want to learn more. And I can't wait to see all of you back here tomorrow for day 3 of our Replace Your Dollar Bootcamp 3.0. Take care, everyone. I will see you tomorrow.